What if I told you that a conflict happening thousands of miles away could end up making certain American companies billions of dollars? Right now, oil prices are moving, markets are reacting, and investors are scrambling to understand what happens next. But instead of focusing on the fear, let's focus on the opportunity, because whenever oil spikes, there are usually a handful of companies positioned to benefit the most. Today, we're looking at 5 stocks investors are watching closely, and the reason could surprise you. Let's dive in. So what's actually happening right now? Over the last few days, tensions in the Middle East have escalated dramatically, and that's caught the attention of investors around the world. Now, here's the interesting part. Most people see headlines about geopolitical conflict and immediately think, that's happening thousands of miles away. Why should I care? But Wall Street doesn't see it that way, because whenever a major conflict involves one of the world's most important energy-producing regions, investors start asking a very different question. Could this impact the global oil supply? And the moment that question enters the market, billions of dollars start moving. Stocks move. Oil prices move. Entire sectors can suddenly become winners or losers. In fact, while most people are focused on the political side of the story, professional investors are already looking ahead and trying to figure out which companies could benefit if energy prices continue rising. And that's where this gets really interesting, because the real story isn't the conflict itself. The real story is what it could mean for oil. And once you understand that, you'll understand why certain stocks are suddenly getting so much attention. So why is oil the real story here? Because oil is still one of the most important resources in the global economy. Think about it. The gas in your car, the trucks delivering products across the country, airlines, shipping companies, manufacturing businesses, almost every part of the economy is connected to energy in some way. And here's what investors are worried about. A significant portion of the world's oil moves through a region that's now at the center of global attention. The market doesn't wait for a supply disruption to happen. It reacts to the possibility of one. That's why even the fear of reduced supply can push oil prices higher. And when oil starts moving, money starts moving too. Investors begin rotating into energy stocks, analysts update their forecasts, fund managers start looking for companies that could benefit from higher oil prices. In other words, the market is already trying to price in what might happen next. And that's exactly why some energy companies are suddenly back in the spotlight, because if oil keeps climbing, their profits could look very different just a few months from now. So the next question is, which companies are investors paying the closest attention to right now? Now you might be thinking, okay, oil prices are moving, but how does that affect me? The answer is probably more than you realize, because when energy costs rise, the effects don't stay inside the oil industry. They spread throughout the entire economy. The most obvious place you'll notice it is at the gas pump. Higher oil prices can eventually translate into higher fuel costs, meaning Americans could end up paying more just to fill up their cars, but it doesn't stop there. Think about the thousands of trucks delivering groceries, packages, and products across the country every single day. Those businesses have fuel costs too. Airlines have fuel costs. Shipping companies have fuel costs. Manufacturers have energy costs. And when those costs rise, they often get passed on to consumers. That's why investors pay such close attention to oil, because it's not just about energy companies. It's about inflation, consumer spending, corporate profits, and ultimately the broader stock market. So while most people see this as an international news story, investors see something very different. They see a potential shift in where money could flow next. And that brings us to the companies investors are watching most closely right now. So if oil continues moving higher, which companies could potentially benefit the most? Let's start with one of the biggest names in the entire energy industry, ExxonMobil. And there's a reason investors always seem to come back to this company whenever oil prices become the center of attention. Exxon isn't some small energy company hoping for a lucky break. It's one of the largest oil producers in the world, with operations that stretch across multiple continents and virtually every part of the energy business. That scale matters, because when oil prices rise, large producers can sometimes generate significantly more revenue from the oil they're already producing. And that's exactly why investors keep a close eye on Exxon during periods of energy market uncertainty. Now, that doesn't automatically mean the stock will go up. Markets are never that simple. But if oil prices remain elevated for an extended period, companies like Exxon are often among the first names analysts start talking about, and that's why Exxon remains one of the most closely watched stocks whenever energy becomes the biggest story in the market. But Exxon isn't the only company investors are paying attention to right now. The second stock on this list has a very similar advantage, and some investors believe it could be just as important. The second company investors are watching closely is Chevron, and in many ways Chevron faces the same opportunity as Exxon, but with a few differences that make it interesting in its own right. Chevron is one of the largest biggest energy companies in America, with massive oil and natural gas operations around the world. So when energy prices rise, investors naturally start paying attention. But here's what makes Chevron stand out. Many investors view it as one of the most financially disciplined companies in the energy sector. In other words, it's not just about producing oil, it's about how efficiently the company turns higher energy prices into profits. That's one reason Chevron has remained a favorite among long-term energy investors for years. Now, just like Exxon, Chevron's future performance will depend on a lot more than oil prices alone. But if energy markets stay tight and oil continues moving higher, Chevron is almost always part of the conversation, and that's why analysts continue watching it closely whenever global events put pressure on energy supplies. But the next company on this list is a little different. Unlike Exxon and Chevron, it doesn't get nearly as much attention from everyday investors, yet some market watchers believe it could be one of the biggest beneficiaries if oil prices remain elevated. The third company on the list is ConocoPhillips. Now, unlike Exxon or Chevron, this isn't usually the first name everyday investors think about when they hear the word oil, but that doesn't mean it's any less important. In fact, ConocoPhillips is one of the largest independent oil producers in the world, and that's exactly why some investors find it so interesting. You see, while companies like Exxon and Chevron operate across multiple parts of the energy business, ConocoPhillips is much more focused on producing oil and natural gas. Why does that matter? Because when oil prices move higher, companies with greater exposure to production can sometimes feel that impact more directly. That's one reason analysts often pay close attention to ConocoPhillips during periods of rising energy prices. The company has major operations across North America and other key energy-producing regions, giving it significant exposure to the global energy market. Of course, higher oil prices don't guarantee higher stock prices, but if energy remains one of the market's biggest themes, ConocoPhillips is a name investors are unlikely to ignore. And now we get to a company that's even less familiar to many people, but could have one of the most direct connections to rising oil prices. The fourth company is Diamondback Energy, and if you've never heard of it before, you're not alone. Unlike Exxon, Chevron, or even ConocoPhillips, Diamondback doesn't get nearly as much attention from the average investor, but that's exactly why some market watchers keep a close eye on it. Diamondback is heavily focused on oil production in the Permian Basin, one of the most important oil-producing regions in the United States, and when oil prices rise, companies with strong production exposure in regions like the Permian can suddenly attract a lot more investor attention. Now, Diamondback doesn't have the global footprint of Exxon or Chevron, but what it does have is focus, and sometimes investors like focused businesses because it's easier to understand how changes in oil prices might impact their results. That's one reason Diamondback often comes up in conversations whenever people start looking beyond the biggest energy names. Again, this isn't about predicting the future, it's about understanding which companies could be affected the most if current trends continue. And that brings us to the final company on the list. What's interesting about this one is that it benefits from the energy market in a very different way than the others we've discussed so far. The fifth and final company is Valero Energy. And what's interesting about Valero is that it plays a very different role in the energy industry compared to the other companies we've discussed. While Exxon, Chevron, ConocoPhillips, and Diamondback are primarily focused on producing oil, Valero is one of the largest oil refiners in the United States. In simple terms, refiners take crude oil and turn it into products people actually use every day, like gasoline, diesel, and jet fuel. And that's where things get interesting, because sometimes it's not just the companies producing oil that benefit from changes in the energy market. The companies processing and refining that oil can become extremely important too. That's one reason investors often watch refiners closely during periods of volatility in energy prices. Valero's business sits right in the middle of that process, connecting raw energy production to products that millions of Americans rely on every day. Now, whether Valero ultimately benefits depends on a variety of market conditions, but when energy becomes one of the biggest stories in the market, it's a company that frequently finds itself back in the spotlight. And when you step back and look at all five companies together, a much bigger picture starts to emerge. The biggest lesson here isn't about buying a stock, it's about understanding how global events can ripple through financial markets in ways most people never expect. A conflict thousands of miles away can impact oil prices. Oil prices can influence inflation. Inflation can affect consumers, businesses, and the stock market. And somewhere along that chain, there are always companies that stand to benefit and others that face new challenges. That's why investors pay attention to events like these, not because they can predict the future, but because they want to understand where opportunities and risks might emerge next. So the question is, which of these companies do you think is best positioned if oil prices prices continue rising, let me know in the comments. And if you enjoyed this breakdown, don't forget to subscribe for more market and investing insights.